Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. You see, as I was preparing to record this video, I came across an insightful bit from a podcast with behavioral finance expert Dr. Daniel Crosby. Dr. Crosby observed that what most people misunderstand about investing is that they focus on all the things that are outside their control. They focus on things that are unforecastable, and which is why they feel helpless like they are right now. On the other hand, you can do wonders in investing if you stay the course, remain long-term oriented, and control the things that we can control. And this is exactly what I'm going to do today. I'm going to talk about how by following few basic principles and sticking to your process, you can ignore all the noise out there and achieve superior long-term returns. So let's start today's presentation with this interesting chart. This is the performance of 10 random portfolios versus the Sensex. As you can see, only one customized portfolio, which is the last one, the one to the extreme right of the screen, has underperformed the benchmark index. It has returned minus 16.3% versus 8.3% for the Sensex. All the other 9 random portfolios have done better than the benchmark index. In fact, look at some of those big returns like 75%, 54%, 46%, and 38%. Those are impressive returns when you consider a 2-year holding period. Yes, that's right. These are CAGR returns. So those big returns that you are seeing like 75%, 54%, 46%, etc. are annual growth rate numbers over a 2-year period. I'm sure you would agree that generating 75% per year is pretty damn good, even if it is for 2 years, or 54% for that matter, or even 46%. Therefore, all said and done, all the customized portfolios have given stellar performance, not just against the benchmark index, but even when you consider the results by themselves. Now here's some more information on each of these 10 portfolios. There is a start date and an end date, and once again the CAGR for each one of them, which is nothing but a repeat of what we saw in the previous slide. Let me tell you that the start and the end date for all the 10 portfolios is completely random. All I did was ask Microsoft Excel, the Excel sheet, to give me 10 random dates over the last 10 years, and this is what it came up with. So each of these start dates has been randomly selected by the computer with no inputs from my side. Now the reason I did this was to remove any bias from the selection of the start dates. I wanted to see whether the performance of the portfolios can hold up irrespective of the start dates chosen. And I'm happy to tell you that the performance has indeed held up quite well. Now I'm sure you would be keen to open the bonnet and see what's under the hood of each of these portfolios. How exactly did these portfolios manage to outperform the Sensex, and that too by such a big margin? What are the kind of stocks these portfolios contain? How should one go about identifying these stocks? You see, in one of the earlier videos I did on the Adani Group shares, I got a comment from a subscriber. He was of the view that being an expert, I should advise beyond the obvious, otherwise there is no point in me being an expert. While he is right that an expert should know things beyond the obvious, I think the role of an expert as far as investing is concerned is to stick to the basics. It is my firm belief that in investing, a person who tries to be consistently less stupid has a huge advantage over someone who is trying to be very intelligent. In fact, in all the 10 portfolios that I have created, all I have done is I have tried not to be stupid and not do anything fancy. I have kept it as simple as possible and yet have achieved outstanding results. As a matter of fact, let us call these portfolios the less stupid portfolios and see how I have gone about constructing them. See, if you're trying to be less stupid, then you have to stay away from loss-making or high PE companies. I think it is stupid to invest in loss-making company or paying a very high multiple even if the underlying quality is good. Over the years, investors have lost the maximum in these two kinds of stocks, and therefore the better you are at avoiding such stocks, the more profits you would be able to make over the long term. Another simple trick is to be able to buy a ₹100 note for ₹80 or lower. In other words, a stock is worth at least its book value. Therefore, if you are able to buy a stock that's trading at 80% of its book value or lower, then you're trying to ensure that you're paying less than the fair value of the company. Theoretically, this means that a minimum upside of 25% is guaranteed as and when the stock goes from ₹80 to ₹100. Which is why each and every stock that I have selected for the 10 portfolios were all trading at 80% or below its book value. Not a single stock in all the 10 portfolios had a price to book value of more than 0.8 times. The next point is about the quality of the company. Now you can spend hours and hours to understand the quality of a company and its management, or you can take a look at a few ratios and figure out within a few minutes whether the quality is good or bad. I prefer the second option, to be honest. Over the years, I have realized that the debt to equity ratio of a company is a good indicator of its quality. A company that has had a close to zero debt to equity ratio over the years is a company that can be considered of decent quality, if not the best. Which is why I prefer companies with zero debt on the balance sheet or a debt to equity ratio that's well under 1x. The highest debt to equity ratio that any of the portfolio companies had was 0.3 times. Yes, you heard that correct. No company in any of the 10 portfolios had debt which was more than 30% of the company's equity. So to recap, we are trying to buy a ₹100 note for ₹80 or lower, and we are interested in buying a stock with the lowest debt possible. The lower the better. Now the next points are a holding period of 2 years, revenues of at least ₹2 billion for the latest financial year, average liquidity of at least ₹1 million over the last 1 year, and all the portfolios are 20 stock portfolios with a 5% allocation to each stock. Well, here's the second slide again, the performance of the 10 portfolios created using simple rules I just highlighted and with random start and end dates. Except for portfolio 10, I think the CAGR returns are pretty impressive, with the minimum being 18.6% for portfolio 9. All of these are of course pre-tax, and you will have to pay a capital gains tax of 10% on each of them. However, even post-tax, these are impressive returns in my view. Now here's another very important slide. To be honest, I don't subscribe to the view that one should be 100% invested all the time. I believe the markets keep swinging between undervaluation and overvaluation, and therefore if you allocate more money to stocks when it is undervalued and allocate less money when it is overvalued, then you stand a good chance of outperforming the Sensex over the long term. And this is exactly what I have done for all the 10 portfolios. You see, long term, the Sensex has averaged a price to earnings multiple of 20 to 21 times. Therefore, if at the start of the 2-year period the Sensex PE was more than 25 times, I have allocated only 25% to stocks and the remaining 75% to fixed deposits, assuming an interest rate of 6% on them. Portfolio 2, Portfolio 4 and Portfolio 5 were the periods where the Sensex PE was more than 25 times, and hence for these portfolios I had assumed only 25% in stocks and the remaining 75% in bonds for the next couple of years. For the others, it was 75% in stocks and 25% in bonds. Now, interesting to note that even with only 25% in stocks, all the 3 portfolios, that is Portfolio 2, 4 and 5, have given a CAGR of more than 20%, which is quite impressive in my view. Well, here are the top 20 performers across all the 10 portfolios. Brightcom Group appears twice, once in Portfolio 5 and once in Portfolio 4, with amazing returns. The stock has been a massive 18-bagger over 2 years. Tanla Platform has also done exceedingly well, a huge 16-bagger for Portfolio 1. Then there are stocks like Graphite India, Tejas Networks, V2 Retail, and others. Therefore, in conclusion, you don't need to do any complicated analysis in order to put together a market-beating portfolio. All you need is a simple buying rule, which in this case is stock with price to book value below 0.8 times and debt to equity close to 0. A simple sell rule, which in this case is a holding period of 2 years, where you are selling all the stocks and building a brand new portfolio with a new set of 20 stocks. Last but not the least, a simple portfolio allocation rule so that you know how much to put in stocks and how much to put in fixed deposits. In our case, an allocation of 25% to stocks if the Sensex PE ratio is more than 25 times, and an allocation of 75% to stocks if the PE ratio is below 25 times. In this approach, you don't pay a lot of attention to any individual stock. You buy a group of 20 stocks where no single stock is more important than the others. All the stocks are on an equal footing and the performance of the overall portfolio is more important than any individual stock. When you use this approach, you don't have to worry about what the stock market is going to do next. Your investment is locked for the next couple of years. If the market goes up, your portfolio will also do well. In fact, it could do a lot better than the market, as we just found out. And if the market goes down, your portfolio can also suffer, but you can always recover and go on to make good money over the next 2-year period. I think it was Ben Graham who once said that the stock market is full of smart, intelligent people. But the reason most of them don't end up doing well is because they do not take the effort to understand the nature of the beast, that is the stock market. The nature of the beast is such that if you follow simple rules and buy cheap and fundamentally decent stocks and take more exposure when markets are cheap and reduce exposure when markets are expensive, you can do better than 90% of the investors out there. Well, my study of the 10 portfolios at 10 different time periods is proof that Ben Graham was indeed right. In the stock market, it always pays to try to be consistently less stupid instead of being more intelligent. So you either do it yourself or subscribe to any of my services to allow me to help you in this endeavor. Drop us an email at info@equitymaster.com. I will repeat that, info@equitymaster.com, and we will help you with the rest of the details. Also, please do not forget to share, comment, and give a like to this video in case you found it to be useful. I will see you again in the next session. Goodbye and take care.